Before we begin, a quick and important disclaimer. The content provided in this video and throughout this entire series is strictly for educational and entertainment purposes only and does not constitute professional financial, legal, insurance, or tax advice. The historical trends, case studies, and international legal frameworks we will be analyzing involve highly complex and localized jurisdictions. Family law, asset division, and insurance regulations vary drastically, not only wildly from country to country, but fundamentally from state to state within the United States. Any discussion regarding asset protection, prenuptial agreements, or risk mitigation strategies is purely conceptual. I am not a licensed financial advisor, nor am I an attorney. You must conduct your own extensive due diligence and consult with qualified, licensed professionals in your specific jurisdiction before making any financial or legal decisions regarding your marriage, your assets, or your estate planning. Do not use the historical concepts discussed in this deep dive as a substitute for personalized legal counsel. Imagine for a moment a catastrophic event that statistically has a 40 to 50% chance of happening to you over the course of your adult life. This event, should it occur, will not only inflict immense emotional and psychological trauma, but will systematically eradicate an average of half to three-quarters of your accumulated net worth in a matter of months. It will force the liquidation of your long-term investments at inopportune times, mandate the sale of your primary residence, trigger complex and punitive tax liabilities, and subject you to tens of thousands of dollars in unavoidable legal fees. If this were a hurricane, a fire, a devastating medical diagnosis, or even a localized flood, the global financial markets would have engineered a highly specific, heavily regulated, and widely accessible insurance product to shield you from the financial fallout. You can insure your smartphone against a cracked screen. You can insure your dog against unforeseen surgical procedures. You can buy specialized policies to protect against identity theft, travel cancellations, and even kidnapping. Yet, for the single most probable wealth-destroying event the average American will ever face, a divorce, the multi-trillion-dollar casualty and property insurance industry remains completely, utterly, and remarkably silent. This is the great, unspoken paradox of American personal finance. We are culturally conditioned to view marriage exclusively through the romantic lens of an eternal emotional bond, willfully ignoring its fundamental, historical reality as a highly complex, legally binding economic merger between two individual corporate entities. When you stand at the altar in the United States, you are signing a joint venture agreement, yet you are doing so without any of the built-in risk mitigation protocols that a standard corporation would require before merging with a competitor. In the early 2000s, a few highly ambitious American entrepreneurs attempted to solve this glaring market inefficiency by introducing the first true casualty insurance policies for divorce. They envisioned a system where a married couple could pay monthly premiums, just like a life insurance policy, and receive a massive cash payout to cover legal fees, housing transitions, and lost assets if the marriage dissolved. Seemed like a billion-dollar idea. But within a few short years, these startups were entirely crushed, regulated out of existence, and banished to the graveyard of financial history. The American insurance regulators and actuaries cited two terrifying concepts: adverse selection and moral hazard. They argued that the only people who would buy divorce insurance were those who already knew their marriages were doomed, collapsing the risk pool. Furthermore, they argued that providing a financial safety net would actively incentivize people to abandon their marriages, turning a sacred institution into a speculative financial wager. But what if I told you that the American perspective on marital financial risk is actually an historical anomaly? What if I told you that for centuries, across drastically different continents and cultures, the concept of mitigating the financial destruction of a broken marriage wasn't viewed as a moral hazard, but as an absolute societal necessity? While American regulators were busy banning modern startups from offering casualty policies, ancient legal systems and international frameworks had already engineered highly sophisticated, built-in financial parachutes that function exactly like modern insurance policies. In other nations, they did not wait for private underwriters to calculate risk pools. They embedded the insurance directly into the cultural and legal fabric of the marriage contract itself. We are going to uncover a hidden history of financial mechanics, exploring how different societies structured their wealth to ensure that the dissolution of a partnership did not result in mutual financial annihilation. This deep dive is going to solve a massive, glaring blind spot in your current understanding of personal finance and asset protection. As an American consumer, you have been taught to meticulously diversify your stock portfolios, to buy term life insurance, to hedge against inflation with real estate, and to build 6-month emergency funds. But you have been left completely exposed without a strategic framework to an event that can wipe out all of those carefully laid plans in a single court ruling. By examining the historical trends and international case studies of how other nations handle marital dissolution, you are going to gain a radically new, paradigm-shifting perspective on risk allocation. You will understand the hidden economic machinery of the marriage contract. We will deconstruct the early American attempts at commercial divorce insurance to understand exactly why they failed, and then we will travel globally to analyze the deferred dowries, the mandatory conditional trusts, and the socialized asset protection schemes of other nations. You will see how the concept of a prenuptial agreement is merely a primitive, often flawed tool compared to the sophisticated historical precedents of built-in marital risk mitigation. This is not just a history lesson. This is a comprehensive masterclass in understanding the true cost of human relationships and how to intellectually conceptualize the defense of your financial legacy. By the end of this journey, you will possess a framework of knowledge that fundamentally alters how you view contracts, commitment, and the preservation of wealth in the modern world. Imagine it is the year 2026, and you are sitting across from your certified financial planner. You are mapping out your long-term wealth strategy, meticulously allocating assets into diversified index funds, securing a 30-year fixed-rate mortgage, and maximizing your tax-advantaged retirement accounts. You feel entirely in control of your financial destiny. But then, an unexpected variable enters the equation. Your spouse, with whom you have commingled every single financial asset for the past decade, decides they no longer want to participate in this joint venture. Instantly, your meticulously crafted financial plan collapses. The legal system steps in, demanding the immediate liquidation of assets, the division of retirement accounts, and the forced sale of that carefully selected real estate, all while you incur tens of thousands of dollars in unavoidable attorney fees. Now, imagine if, during that same financial planning meeting years prior, you had been able to purchase a standardized casualty policy designed specifically to absorb this exact shock. Imagine if a monthly premium of just $50 or $100 had secured a potential tax-free lump sum payout of $50,000 the moment a judge signed your final dissolution decree. This theoretical payout would instantly cover the exorbitant retainer fees for your legal representation, secure the security deposit on a new residence, and provide a critical liquidity bridge, so you would not be forced to sell off your stocks at a massive loss during a market downturn. This scenario is not mere financial science fiction. It is precisely what a real enterprise called Safeguard Guarantee Corporation attempted to bring to the American public back in 2010 with a product they named Wedlock. This historical case study is absolutely crucial for understanding why the United States views marital risk so differently than the rest of the world. The architects of this product approached marriage with the cold, calculating precision of corporate risk analysts. They recognized a massive, unaddressed vulnerability in the American financial system. Statistics showed that marital dissolution had a higher probability of occurring than home fires, auto accidents, or severe medical emergencies. Yet it was the only major life catastrophe left entirely uninsured by the private sector. Their solution was mathematically elegant. Policyholders could purchase units of coverage for approximately $16 a month. Each unit provided a base payout of over $1,000, and the value of that payout systematically increased for every year the couple remained married. To combat the terrifying specter of adverse selection, meaning the risk that only people already planning to separate would buy the policy, the company instituted a mandatory 48-month waiting period. If your partnership dissolved before those 4 years elapsed, you received nothing but your initial premiums back. It was a structural safeguard designed to ensure that the risk pool remained solvent and balanced. Yet, despite this actuarial brilliance, the experiment was a catastrophic failure. The company faced insurmountable resistance from state insurance commissioners, overwhelming cultural backlash, and the eventual withdrawal of their underwriting partners. The American regulatory framework, deeply intertwined with cultural idealism, simply could not stomach the commodification of marital dissolution. Critics publicly argued that offering a financial safety net for this specific event would actively incentivize the destruction of the nuclear family. They classified it as a profound moral hazard, suggesting that if individuals knew they would not face total financial ruin, they would be far more likely to abandon their commitments at the first sign of interpersonal friction. Consequently, the product was effectively regulated into oblivion, leaving the American consumer in 2026 completely exposed to the whims of family court, armed with nothing but primitive, often heavily contested prenuptial agreements. But as we pivot our historical lens away from the United States and look toward international borders, a fascinating reality emerges. While American regulators were busy debating the moral implications of private casualty policies, other societies had already solved this exact problem centuries ago. They did not rely on private corporations, venture capitalists, or monthly premiums to build their safety nets. Instead, they recognized that the financial destruction of a broken partnership was a threat to societal stability itself. Therefore, they embedded the mechanics of risk mitigation directly into the cultural and legal fabric of the marriage contract from the very beginning. Consider the historical and ongoing application of the Islamic mahr, a concept frequently misunderstood by Western observers but functioning, in pure economic terms, as a highly sophisticated, mandatory form of localized wealth protection. In this system, the contract legally requires the groom to pledge a specific financial sum or valuable asset to the bride. This is not a dowry paid to her family. It is her exclusive, legally protected property. Crucially, this obligation is often divided into two distinct components: a prompt portion paid at the time of the ceremony, and a deferred portion. This deferred portion is the true mechanical equivalent of a casualty payout. It acts as a legally binding, pre-negotiated financial settlement that becomes immediately payable to the wife in the event of a separation initiated by the husband, or upon his death. Let us analyze the economic genius of this international framework. By establishing a deferred financial obligation at the inception of the union, the system simultaneously accomplishes two primary goals that American insurance companies could never achieve. First, it completely eliminates the moral hazard that terrified American regulators. Because the individual knows exactly how much capital he will instantly forfeit upon initiating a separation, the deferred obligation acts as a powerful economic deterrent against frivolous or impulsive action. It forces a rigid cost-benefit analysis before any legal mechanism is triggered. Second, it ensures that the structurally more vulnerable party possesses immediate, liquid capital to secure housing and living expenses without enduring a protracted, wealth-destroying legal battle over jointly held assets. There is no need for a monthly premium, no underwriter that can go bankrupt, and no state regulatory fund required. The risk mitigation is entirely self-contained within the localized economic unit of the household itself. This historical comparison exposes the fundamental vulnerability of the American approach. By strictly separating the romantic ideal of partnership from its underlying economic reality, the United States has inadvertently created an environment where the dissolution of a union results in maximum financial carnage. We rely on a reactionary legal system to painfully untangle commingled assets after the disaster has already occurred, enriching attorneys while destroying generational wealth. In stark contrast, these international models demonstrate a proactive approach, utilizing deferred capital obligations to establish clear financial parameters and built-in parachutes long before any conflict arises. The failure of commercial policies in the United States was not a failure of the concept itself. It was a failure of the delivery mechanism. The risk is undeniably real, and the need for mitigation is mathematically absolute. As we analyze these divergent historical trends, a critical question begins to surface for the modern American individual managing their wealth. If the state will not allow private companies to sell you a protective policy, and if our cultural traditions do not provide a built-in financial parachute, how can you engineer your own private equivalent? The answer lies in understanding how modern European frameworks have taken these ancient concepts of embedded protection and supercharged them through highly regulated asset defense schemes. They have created systems where the state itself dictates the rules of engagement, completely restructuring how marital property is acquired and divided. When we uncover exactly how these European tribunals operate, you will realize that the American concept of default joint ownership is not just flawed. It might be the most dangerous financial assumption you will ever make. Let us completely deconstruct the standard American legal apparatus functioning right now in 2026. If you are a resident named Michael living in Chicago, and you marry Sarah the moment you sign that legal document, you are instantly, by default, subjected to a system that operates on the premise of financial commingling. In the United States, we rely almost exclusively on either community property laws or equitable distribution frameworks, depending on your state. Both of these frameworks require a catastrophic, backward-looking forensic accounting process when a marriage dissolves. You have to hire financial experts to look into the past, untangle years of joint bank accounts, assess the appreciation of individual assets, and fight over who contributed what to the marital estate. This untangling process is precisely what destroys the wealth. the legal fees, the forced appraisals, the emotional negotiations over the family home. This is the friction that burns your capital to the ground. You are essentially building a skyscraper without any structural joints, and when the earthquake hits, the entire building fractures at once. Now let us cross the Atlantic and examine the mechanical brilliance of the default German marital property regime, known legally as Zugewinngemeinschaft, or the community of accrued gains. This is a system of state-sponsored risk mitigation that acts as a profound evolutionary leap over the American method. In this framework, the legal system does not assume that your assets merge into a single pot upon marriage. Instead, it operates on a strict separation of property during the active lifespan of the partnership. If Michael brings a privately held software company into the marriage, and Sarah brings a robust real estate portfolio, those assets remain fiercely independent. There is no commingling. The ownership titles do not shift. During the marriage, Michael manages his company, and Sarah manages her real estate, entirely autonomously. The genius of this European tribunal model activates only at the exact moment of dissolution. Instead of fighting over the core assets, the German system mathematically calculates the precise financial growth that occurred exclusively during the marital years. They establish a rigid baseline valuation for Michael's company and Sarah's real estate on the day of the wedding. Then, on the day of the divorce, they evaluate the exact same assets. The court only looks at the mathematical difference, the accrued gain. If Michael's company grew by $1 million and Sarah's portfolio grew by $200,000, the total marital gain is $1.2 million. The system simply equalizes that specific growth. Michael retains absolute control and ownership of his company. Sarah retains absolute control and ownership of her properties. There is no forced liquidation of the underlying business. There is no need to sell the real estate to satisfy a punitive capital division. The structural integrity of their premarital wealth remains completely intact, shielded by the default laws of the state. Imagine if this framework were applied to the American public in 2026. The entire infrastructure of the multi-billion-dollar divorce industry would instantly collapse. The need for commercial divorce insurance, like the failed concepts we discussed earlier, is entirely eradicated in Germany because the legal system itself provides the structural parachute. It mathematically prevents the catastrophic destruction of the foundational assets. You do not need to buy a casualty policy to protect your business from your spouse, because the state has already engineered a firewall between your premarital capital and your marital obligations. But the historical trends of European wealth protection go even further than the accrued gains model. Let us travel to France and examine the concept of the separation of goods, or séparation de biens. While the French default system has historical variations, any modern couple with significant assets, family businesses, or complex inheritances immediately opts into this highly formalized, ironclad separation structure before a specialized legal official known as a civil law notary. This is not a simple prenuptial agreement drafted by two combative lawyers. This is an elevated, state-sanctioned contract that completely opts out of any shared marital economy. Every single bank account, every vehicle, every share of stock, and every piece of real estate is strictly categorized from day one. If Michael buys a car, he uses his separate funds and the car is his. If Sarah buys an investment property, she uses her separate funds, and the property is hers. This creates a fascinating historical comparison with the United States. In America, attempting to keep your finances completely separate during a marriage is culturally stigmatized as cynical, unromantic, and a sign of a lack of commitment. In the French wealth management tradition, it is viewed as a pragmatic, necessary administrative task to prevent future chaos. By establishing these rigid boundaries from the very beginning, the French eliminate the potential outcomes of massive legal disputes over asset characterization. When a marriage under a separation of goods regime ends, there is virtually nothing to untangle. The financial separation already occurred years ago, on the day the marriage began. The divorce is merely a legal administrative stamp on an economic reality that has existed the entire time. These European frameworks demonstrate a profound truth about financial risk mitigation. The most effective insurance policy against the dissolution of a partnership is not a financial product you buy from an underwriter. It is the structural architecture of the partnership itself. By default, these nations engineer marriages as side-by-side parallel paths rather than deeply intertwined, inescapable knots. They prioritize the preservation of the underlying capital and the continuity of enterprise over the emotional symbolism of merged bank accounts. They recognize that human relationships are inherently volatile, and they build their legal systems to absorb that volatility without destroying the economic output of the individuals involved. We are beginning to see how different societies conceptualize the defense of wealth. The United States relies on a messy, post-disaster cleanup, while the European models rely on proactive, structural firewalls. But these state-level frameworks are designed for the middle class and the moderately wealthy. They are the default settings of the general public. What happens when the stakes are exponentially higher? What happens when we are not talking about a software company or a few real estate properties, but instead we are dealing with vast, multi-generational dynasties, international conglomerates, and the kind of wealth that moves global markets? How do the absolute ultra-wealthy approach the mathematical certainty of marital risk? As we will see, they do not rely on local family courts, nor do they trust default state frameworks. They build sovereign financial fortresses using legal tools that the average citizen does not even know exist. They utilize international trust jurisdictions, offshore corporate veils, and layers of legal anonymity to ensure that a divorce court judge cannot even locate their assets, let alone divide them. You are about to enter the hidden, high-stakes world of irrevocable wealth shielding, and what you discover will permanently change your understanding of how true power protects itself. The fundamental premise of ultra-high net worth asset defense completely inverts the standard American financial paradigm. While the average citizen spends their entire life trying to accumulate and legally own as many assets as possible, the true apex of wealth management is built on the exact opposite philosophy. To legally protect an asset from forced liquidation or division in a family court, you must completely and irrevocably relinquish ownership of that asset. You cannot lose what you do not legally possess. This is the mechanical core of the Irrevocable Asset Protection Trust, a highly complex financial instrument that acts as the ultimate, self-funded insurance policy against the potential outcomes of marital dissolution. Imagine it is the year 2026. Our hypothetical American individual, Michael, has successfully scaled an industrial logistics company in Chicago, and its current valuation sits at roughly $200 million. He is engaged to be married to Sarah. A standard financial advisor operating in the middle-class paradigm might suggest a traditional prenuptial agreement. But Michael understands historical trends and the vulnerabilities of standard contracts. He knows that prenuptial agreements are routinely challenged in litigation, scrutinized for coercion, or outright invalidated by family court judges who deem the terms unconscionable at the time of enforcement. Instead of relying on a fragile piece of paper that must survive the scrutiny of a domestic judge, Michael engineers a structural fortress. Years before the wedding bells ring, he executes a sophisticated legal maneuver and transfers the vast majority of his holding company shares into a specialized legal vehicle known as a domestic asset protection trust, specifically domiciled in a strategically favorable state like South Dakota or Nevada. Let us explore the step-by-step details of why a state like South Dakota has become a premier jurisdiction for domestic wealth shielding. Over the past several decades, specific states have engaged in fierce legislative competition to attract trust capital. South Dakota eliminated the rule against perpetuities, meaning a trust can theoretically exist forever, shielding generational wealth from estate taxes indefinitely. More importantly for our case study, South Dakota has enacted ironclad privacy statutes and heavily restricted the ability of outside creditors, explicitly including ex-spouses in many scenarios, from piercing the trust veil. When Michael creates this trust, he is the grantor. He transfers the assets into the legal vehicle. A corporate entity located in Sioux Falls becomes the legal trustee. Michael might remain a discretionary beneficiary, meaning he can receive distributions from the trust if the trustee allows it, but structurally, he legally owns absolutely nothing. What happens to this structure during a marital collapse? When the marriage dissolves, the Chicago family court judge demands a full accounting of the marital estate for equitable distribution. Sarah and her legal team point to the $200 million logistics company, but Michael and his defense team present a profound, mathematically undeniable legal reality. Michael does not own that company. A trust in South Dakota owns it. The Chicago judge may issue an aggressive order demanding the division of the shares. However, the South Dakota trustee, legally bound by the strict fiduciary duties and protective statutes of their specific state jurisdiction, reviews the order from Illinois and legally refuses to comply. South Dakota law is specifically designed to shield these trust assets from the judgments of other states, creating an immediate administrative deadlock. The legal friction itself becomes the defense. The cost? time and jurisdictional complexity required to fight a sovereign state's trust laws forced the opposing party to accept a drastically reduced settlement. The trust acts exactly like a massive insurance payout, preserving the core asset by making it too expensive and legally perilous to attack. But for the global elite, even a domestic trust in South Dakota presents unacceptable domestic risks. Federal judges can sometimes override state statutes, and domestic political winds can change. The historical trend over the last 3 decades shows a massive capital flight towards sovereign international jurisdictions that have legislated themselves into impenetrable wealth vaults. Welcome to the world of the Offshore Asset Protection Trust, utilizing jurisdictions like the Cook Islands or the Federation of St. Kitts and Nevis. When a high-net-worth individual establishes a Cook Islands trust, they are moving their wealth entirely outside the jurisdiction of the United States legal apparatus. The mechanics of the Cook Islands framework are staggering in their defensive capability. The Cook Islands government intentionally authored their trust legislation to attract global capital by refusing to recognize foreign court judgments. If an American family court issues a sweeping judgment demanding the liquidation of assets held within a Cook Islands trust to satisfy a divorce settlement, the local Cook Islands trustee is legally prohibited by their own nation's laws from honoring that foreign judgment. The American court order is functionally a worthless piece of paper in the South Pacific. If a spouse wants to claim those assets, they cannot rely on their local domestic judge. They must physically travel to the Cook Islands, hire local legal counsel who are often prohibited from working on contingency, and initiate a completely new lawsuit under Cook Islands law. Furthermore, the legal threshold to successfully penetrate a Cook Islands trust is nearly insurmountable. To prove a fraudulent transfer, the opposing spouse must prove their case beyond a reasonable doubt, which is the standard reserved for criminal murder trials in the United States, not civil financial disputes. Additionally, the statute of limitations to bring such a claim is ruthlessly short, often expiring just 1 or 2 years from the initial creation of the trust. By the time a marriage dissolves a decade later, the legal window to attack the trust has definitively slammed shut. This architecture functions identically to the theoretical commercial divorce insurance policies we analyzed earlier, but it operates without the need for an underwriter, a monthly premium, or an American regulatory body. The potential outcomes are mathematically locked in through jurisdictional arbitrage. The wealthy individual is essentially underwriting their own risk by leveraging the sovereign laws of foreign nations. They are substituting the moral hazard of a commercial insurance policy with the absolute, unyielding legal friction of international borders. The core capital remains completely insulated from the emotional volatility of human relationships and the unpredictable nature of domestic family courts. But no financial fortress is entirely impregnable, and the evolution of wealth shielding has spawned an equally sophisticated counter-industry. What happens when the spouse facing this imposing wall of offshore secrecy refuses to surrender? What happens when they deploy former intelligence officers, international forensic accountants, and dark web financial trackers to pierce the corporate veil, trace the hidden wires, and expose the underlying mechanics of the trust? You are about to witness the modern arms race of marital asset recovery, a hidden war where finding the money requires navigating global shell companies, decrypting shadow ledgers, and triggering high-stakes legal warfare across multiple continents. The offshore trust may be an impenetrable legal vault, but every vault requires a supply line. To move $200 million from a Chicago logistics firm into a sovereign financial fortress in the South Pacific, a massive, highly complex logistical operation must occur, leaving behind an indelible trail of digital breadcrumbs. Imagine Sarah, our hypothetical spouse in the year 2026, refusing to accept the sudden, devastating revelation that her husband Michael officially owns nothing. She does not capitulate. Instead, she pivots from traditional family law attorneys and retains the services of specialized, ultra-high net worth asset recovery firms. These firms operate more like private intelligence agencies than law firms. They are staffed by former federal investigators, elite forensic accountants, and data scientists whose sole professional existence is dedicated to dismantling the exact wealth shielding structures we just analyzed. The first phase of this counteroffensive bypasses the Cook Islands entirely and focuses intensely on domestic financial intelligence. The recovery team understands a fundamental historical trend. Money cannot physically teleport. It must traverse the global banking system. They begin by subpoenaing domestic bank records to perform what is known as a source and use analysis. They are looking for the exact moment the capital exited the United States. They analyze the SWIFT messaging network, the international messaging system that banks use to securely transmit instructions for wire transfers. A swift trace can reveal the correspondent banks used to funnel the money, exposing the intermediate shell companies set up in jurisdictions like Delaware or Wyoming before the funds ultimately landed offshore. But the investigation goes much deeper than just bank statements. These forensic teams meticulously dissect years of complex corporate tax returns, looking for subtle discrepancies, unexplained losses, or foreign bank account reporting forms that might have been inadvertently filed or intentionally omitted. Furthermore, the asset recovery team scrutinizes the behavioral footprint of the individual. They analyze passport stamps, private aviation flight logs, and credit card expenditures. Did Michael take sudden, unexplained trips to Geneva, the Cayman Islands, or the Isle of Man in the years immediately preceding the marital collapse? Did he begin paying exorbitant, recurring legal retainer fees to international law firms specializing in wealth management? They look for the badges of fraud, the specific, recognized behaviors that indicate an individual is actively attempting to conceal assets in anticipation of litigation. This is not merely an accounting exercise. It is a full-scale psychological and logistical audit of a person's entire financial existence over a multi-year timeline. However, the absolute weakest link in any offshore asset protection matrix is rarely the mathematics of the trust itself. It is the human element. The historical case studies of massive offshore wealth exposures demonstrate that impenetrable fortresses are almost always breached from the inside. Asset recovery teams actively hunt for human vulnerabilities within the opposing camp. They interview disgruntled former business partners, dismissed administrative assistants, and estranged family members. They know that to maintain a $200 million shadow enterprise, you need a team of accountants, lawyers, and wealth managers. If even one of those individuals left the enterprise on bad terms, they become a potential goldmine of evidentiary leverage, capable of providing the exact internal memos, shadow ledgers, or email communications needed to prove the trust was established with the specific, fraudulent intent of defeating marital obligations. But let us assume Michael executed the transfer flawlessly. There are no leaks, no disgruntled employees, and the money is safely locked within the Cook Islands Trust. The foreign trustee refuses to recognize the Chicago Family Court's jurisdiction. This is where the American legal system deploys its absolute nuclear option. The Chicago judge may not have jurisdictional authority over the sovereign nation of the Cook Islands, but that judge possesses absolute, terrifying physical jurisdiction over Michael, the grantor of the trust, who is currently standing inside the Illinois courtroom. The legal countermeasure deployed here is the mechanism of civil contempt. The asset recovery team will argue that Michael's inability to pay the marital settlement is a self-created impossibility. They will present historical legal precedents where United States judges have looked at a wealthy individual claiming they have no control over their offshore money and utterly rejected that premise. If the court determines that Michael retained a hidden mechanism of control, perhaps he appointed himself as a protector of the trust with the power to fire the trustee, or perhaps he established a pattern of the trustee automatically rubber-stamping his investment requests, the judge will conclude the offshore structure is a sham. The judge will issue a direct court order compelling Michael to repatriate the funds. When Michael inevitably claims that the foreign trustee refuses to release the money due to the duress clause in the trust document, the judge can hold Michael in civil contempt of court. The potential outcomes of this maneuver are severe. The judge can order Michael to be incarcerated in a county jail, not as a punishment for a crime, but as a coercive measure to force compliance. He holds the keys to his own cell. He will be released the exact moment he figures out how to bring the money back. This intense legal pressure often forces a massive, highly favorable financial settlement for the pursuing spouse, completely circumventing the offshore legal firewall by applying unbearable physical leverage to the individual. In parallel to this domestic pressure campaign, the asset recovery team will launch a global offensive using international legal instruments. They will seek a Mar-Eva injunction, a highly aggressive, worldwide freezing order originating from a cooperative jurisdiction. This legal weapon is designed to instantly paralyze assets across the globe before they can be further dissipated. They will send letters rogatory, formal requests from a domestic court to a foreign court, demanding international judicial assistance in seizing property. They will attempt to freeze the correspondent banking accounts of the offshore trust, essentially starving the trust of its ability to move capital into or out of the global financial system. It is a war of financial attrition, designed to make the continued defense of the hidden assets so exorbitantly expensive and legally perilous that the trust structure itself collapses under the sheer weight of the litigation. We have now seen how the ultra-wealthy use international borders to build financial insurance policies, and we have seen the devastating multi-million-dollar forensic wars fought to tear those policies down. This entire battlefield relies on the traditional global banking system, SWIFT networks, human trustees, and legal jurisdictions. It relies on the fundamental premise that wealth must be held by an institution. But what happens when that foundational premise is completely obliterated? What happens when the wealth you are trying to divide or protect exists completely outside of any bank, any government, and any physical jurisdiction on Earth? In the year 2026, family courts are facing a terrifying new frontier that makes offshore trusts look like antiquated relics of a bygone era. You are about to discover how the immutable mathematics of cryptographic ledgers have created the ultimate, highly volatile financial parachute, and why dividing a digital fortune might be the most complex legal puzzle ever devised. Imagine it is the year 2026. The standard American family court system, entirely designed to subpoena traditional bank managers, freeze fiat currency accounts, and assess the value of tangible real estate, suddenly collides with a mathematical protocol that fundamentally does not care about judicial authority. In the traditional centralized banking system we explored previously, a domestic judge signs a piece of paper, and an institution complies. But on a decentralized blockchain, there is no chief executive officer to subpoena, there is no customer service department to threaten with civil contempt, and there is no central server to physically shut down. If our hypothetical husband, Michael, anticipating the collapse of his marriage, decided to liquidate $20 million of his logistics company and convert it entirely into a digital bearer asset like Bitcoin, he has effectively removed that immense wealth from the physical jurisdiction of the United States without ever leaving his living room. This represents a violent paradigm shift in the historical trends of wealth shielding and marital asset division. Unlike the complex Cook Islands Trust, which requires a foreign corporate trustee and a paper trail of international wire transfers, cryptocurrency operates on the uncompromising principle of self-custody. The entirety of that $20 million is secured by a cryptographic seed phrase, a simple analog string of 12 to 24 randomized words. If Michael memorizes those specific words and burns the physical paper backup, that massive fortune ceases to exist in the physical realm. It lives entirely and exclusively inside his mind. To understand why this scenario is the most complex legal puzzle ever devised, we must meticulously deconstruct the step-by-step mechanics of a digital bearer asset compared to traditional property. Historically, a bearer asset was a physical object, such as a gold bar, a diamond, or a paper bearer bond. Whoever physically held the object was recognized as the legal owner. Cryptocurrency digitizes this exact concept. When wealth is stored in a non-custodial hardware wallet, it becomes completely immune to the standard global freezing orders or Mar-Eva injunctions that asset recovery teams deploy against offshore bank accounts. A judge can certainly issue a court order demanding Michael hand over the digital assets for equitable distribution. But if Michael stands in the courtroom and claims he tragically lost the hardware wallet in a boating accident, or that he simply forgot the complex password due to extreme stress, the legal system hits an unprecedented, impenetrable brick wall. You cannot mathematically force a cryptographic network to reverse a transaction, and you cannot physically seize funds that are locked behind unbreakable encryption. The historical concept of the state acting as the ultimate, forceful arbiter of property division is fundamentally broken by the mathematics of decentralized ledgers. This creates a terrifying, highly volatile form of shadow divorce insurance, where the spouse holding the private keys holds absolute, unyielding financial leverage over the entire marital estate, effectively holding the capital hostage. But just as the ultra-wealthy developed offshore trusts, the forensic asset recovery industry of 2026 has rapidly evolved highly sophisticated countermeasures to combat this cryptographic evasion. When Sarah realizes the $20 million has vanished into the digital ether, her forensic team does not waste time subpoenaing local banks. They immediately deploy advanced blockchain analytics. While it is a common misconception that all cryptocurrency is entirely anonymous, the vast majority of public ledgers are completely transparent. Every single transaction that has ever occurred since the inception of the network is permanently recorded for anyone to see. The forensic investigators utilize powerful software to trace the digital breadcrumbs. They look for the critical on-ramps and off-ramps. Did Michael use a centralized cryptocurrency exchange located within the United States to purchase the initial digital assets? Because domestic exchanges are strictly bound by Know Your Customer regulations, they require government identification. The forensic team can legally subpoena that exchange, definitively link Michael's real-world identity to a specific digital wallet address, and mathematically track exactly where those funds were subsequently sent. They will trace the capital as it hops through digital tumblers, highly complex cross-chain bridges, and decentralized finance protocols, painstakingly rebuilding the map of the missing wealth transaction by transaction. However, the historical trends of financial evasion dictate that the tactics of concealment are always evolving to stay one step ahead of the recovery tools. What happens when the transparent public ledger is intentionally bypassed? Enter the realm of privacy-centric protocols, which utilize advanced cryptographic techniques like ring signatures and stealth addresses to completely obfuscate the sender, the receiver, and the transaction amount. If Michael funnels his wealth through a dedicated privacy network, the digital forensic trail goes completely dark. It is the technological equivalent of dropping a bag of untraceable cash into a black hole. In these specific case studies, the digital recovery team must abandon blockchain tracking entirely and revert to aggressive physical world surveillance. The battle shifts away from the ledger and back to the physical reality of the marital home. Investigators will deploy digital forensics experts to image Michael's electronic devices, searching for encrypted text files, hidden partitions on his laptop hard drives, or deleted photographs of a piece of paper containing the master seed phrase. They will hunt for physical hardware wallets hidden in undisclosed safety deposit boxes, concealed wall safes, or entrusted to completely oblivious family members. Even if Sarah's team successfully locates and secures the digital assets, the family court of 2026 faces an entirely new catastrophic problem: the valuation paradox. Traditional assets such as a primary residence or a blue-chip stock portfolio generally hold relatively stable valuations over the short duration of a legal proceeding. Digital bearer assets do not. Imagine the court orders the equitable division of a massive portfolio of cryptocurrency tokens. On the day the trial begins, those assets might be valued at $10 million. By the time the judge signs the final dissolution decree 3 months later, extreme market volatility could have crashed the value to $4 million or spiked it to $20 million. The legal system is simply not architecturally designed to handle assets that experience such violent, real-time price fluctuations. If the court orders a fixed dollar amount payout based on an outdated valuation, Michael might be forced to liquidate his entire digital portfolio during a massive market crash, incurring massive capital gains taxes and completely destroying his remaining net worth. Alternatively, if Sarah is awarded a direct percentage of the tokens, she is being handed a highly speculative asset that could collapse the next day, entirely defeating the purpose of a secure, reliable financial settlement. We are witnessing a systemic failure of the traditional American family court system to manage 21st century wealth. The reliance on backward-looking forensic accounting is being actively destroyed by the speed, obfuscation, and extreme volatility of decentralized finance. The modern individual is realizing that relying on a human judge to untangle a digital, cryptographic mess is a recipe for mutual financial annihilation. But what if the solution to this chaos is not found in hiding assets or fighting protracted battles in court? What if the very technology that is causing this legal nightmare contains the exact tools needed to definitively solve it? What if, instead of trusting a judge, a fragile piece of paper, or a foreign offshore trustee, a couple could mathematically code their prenuptial agreement directly into an immutable blockchain? You are about to discover the radical emerging world of programmable marriages, where self-executing smart contracts automatically finalize the division of assets the very millisecond a legal condition is met, eliminating lawyers, judges, and human error entirely from the equation. This concept of a programmable marriage fundamentally alters the very nature of human contracts. To understand the sheer magnitude of this historical shift, we must first analyze the fatal flaw inherent in every single traditional prenuptial agreement ever drafted by an American family law attorney. A traditional legal contract is essentially a piece of paper containing a promise about future behavior. It relies entirely on the assumption that years or decades from now, both individuals will voluntarily honor that promise, or that a domestic judge will force them to comply. It introduces massive points of friction, human interpretation, and legal maneuvering. In the year 2026, the integration of decentralized network architecture allows our hypothetical couple, Michael and Sarah, to completely eliminate the need for human trust. Instead of hiring opposing legal counsel to argue over subjective definitions of fairness, They hire specialized legal engineers and blockchain developers. Together, they author a digital prenuptial agreement coded directly into an immutable Layer 1 blockchain. This is not a static document stored in a filing cabinet. It is an active, self-executing software protocol that physically holds custody of their digital wealth. Let us explore the step-by-step mechanics of how this automated risk mitigation framework actually functions in practice. Michael and Sarah do not just hold their wealth in traditional bank accounts. Through the accelerated adoption of asset tokenization, their entire marital estate is digitized. The deed to their primary residence in Chicago is represented by a non-fungible token, granting legal ownership rights. The shares of Michael's massive logistics company are issued as cryptographic security tokens. Even their liquid cash reserves are held in fully backed digital stablecoins. Upon finalizing their programmable agreement, they transfer all of these digital assets into a specialized smart contract, acting as an unyielding digital vault. During the active lifespan of their marriage, this vault operates as a multi-signature wallet. If they want to sell a tokenized asset or allocate funds for a major real estate acquisition, the protocol mandates that both Michael and Sarah must cryptographically sign the transaction with their respective private keys. It is the ultimate manifestation of the European separation of goods concept we analyzed earlier, but mathematically enforced by a global network of computers rather than a civil law notary. The true revolutionary power of this framework activates during a marital collapse. In the traditional American system, initiating a divorce triggers months or years of forensic discovery, hidden asset searches, and agonizing courtroom battles. In the programmable paradigm, the dissolution instructions are hard-coded into the digital vault from day one. But a critical question arises. How does an isolated digital blockchain know that a physical legal divorce has occurred in a local jurisdiction? The answer lies in the deployment of a decentralized Oracle network. An Oracle is a highly secure data bridge that feeds real-world information into a blockchain. In our 2026 case study, the smart contract is programmed to constantly monitor the specific application programming interface of the local Illinois family court docket system. It is waiting for a single hyper-specific digital event to occur. Imagine the scene. A Chicago judge reviews the dissolution paperwork and digitally signs the final decree, officially terminating the marriage. The very millisecond that electronic signature registers in the county database, the decentralized Oracle detects the status change. The Oracle instantly broadcasts this verified data point back to the smart contract holding the tokenized marital estate. What happens next takes less time than a heartbeat. There is no appeal period. There are no letters rogatory. There are no frantic calls to offshore trustees in the Cook Islands. The smart contract, completely devoid of human emotion or judicial bias, executes its predetermined code. If the original programmable agreement dictated a mathematically precise 55 to 45% split of all liquid stablecoins, and mandated that the tokenized deed to the primary residence defaults to Sarah, the network executes those transfers instantaneously. Millions of dollars of wealth and real estate ownership rights are routed directly to their sovereign, individual digital wallets. The cost of this perfect, friction-free asset division is merely the fractional network gas fee required to process the transaction. This programmable architecture also revolutionizes the historically contentious issue of ongoing spousal support. In the traditional paradigm, alimony requires one individual to manually write a check every single month. This creates endless opportunities for missed payments, aggressive enforcement actions, and a perpetuation of emotional trauma as the two parties are forced into a continuous financial relationship. Using programmable protocols in 2026, Michael and Sarah can utilize advanced digital money streaming. The smart contract can be instructed to automatically stream a microfraction of a digital dollar every single second of every single day into Sarah's wallet for a predetermined duration of 5 years. This stream flows autonomously. If the funding wallet drops below a certain liquidity threshold, the protocol can automatically liquidate a portion of Michael's tokenized logistics company shares on a decentralized exchange to ensure the continuous flow of capital. The compliance is not enforced by a judge wielding the threat of civil contempt. It is enforced by the unyielding architecture of the code itself. However, we must aggressively analyze the potential outcomes of adopting such extreme, rigid mathematical systems for highly complex human relationships. The historical trends of family law demonstrate that flexibility is often required to address unforeseen tragedies. What happens if, 5 years into this programmable marriage, Sarah suffers a catastrophic medical event that requires massive, unexpected financial resources? In a traditional legal system, a judge can review the new circumstances, override a standard prenuptial agreement, and order an equitable distribution of assets to prevent her from becoming a ward of the state. But the smart contract does not understand empathy, medical diagnoses, or equity. It only understands its original programming. If the protocol requires Michael's private key to alter the terms, and he refuses to provide it, the digital vault remains locked, entirely indifferent to the physical reality of human suffering. Furthermore, the reliance on experimental code introduces the terrifying specter of technical vulnerabilities. If a highly sophisticated malicious actor discovers a flaw in the multi-signature protocol, they could theoretically drain the entire $20 million tokenized marital estate into an anonymous ledger, completely destroying both individuals' net worth in an unrecoverable instant. We are beginning to see the absolute limits of using assets, whether physical, offshore, or purely digital, as the foundation for marital risk mitigation. You can offshore the capital, you can encrypt the ledger, and you can program the payouts with mathematical perfection, but you are still treating the marriage as a romantic union that coincidentally owns things. What if we completely destroy that foundational premise? What if the ultimate, impenetrable form of defense has absolutely nothing to do with hiding money or writing code? What if the most highly strategic families in 2026 are entirely abandoning the traditional state-sanctioned marriage certificate, and instead, forming localized corporate entities to govern their daily lives? You are about to enter the bizarre, hyper-rational world of the marital limited liability company, where spouses are no longer recognized as husband and wife, but rather, as the chief executive officers and primary shareholders of an incorporated domestic enterprise. The fundamental vulnerability of the American family court system is that it relies on a judicial philosophy known as equity. Equity is a highly subjective legal concept that essentially translates to whatever a specific judge determines is fair on any given Tuesday. When you merge your financial life through a standard state-issued marriage certificate, you are implicitly agreeing to let a stranger determine what is fair if the union dissolves. To the ultra-wealthy and legally strategic individuals operating in the year 2026, relying on subjective fairness is an unacceptable financial risk. They understand that to achieve absolute predictability, you must abandon the emotional jurisdiction of family court entirely and forcefully migrate your domestic partnership into the cold, mathematically precise jurisdiction of commercial contract law. This is the architectural genius behind the marital limited liability company. Imagine our theoretical couple, Michael and Sarah. Instead of merely driving to the local county clerk to sign a standard marriage license, they hire specialized corporate architects. Before any romantic ceremony takes place, they file articles of organization with the Secretary of State in a highly corporate-friendly jurisdiction like Delaware or Wyoming. They establish a legal entity, perhaps named the Smith-Jones Domestic Enterprise LLC. Michael and Sarah are not legally defined within this structure as husband and wife. They are formally designated as the managing members of the corporation. The true power of this strategy lies in the creation of the operating agreement. This document replaces the inherently flawed, easily contested prenuptial agreement. An operating agreement is the foundational constitution of a corporate entity, and commercial courts enforce them with ruthless efficiency. Inside this document, Michael and Sarah meticulously define the economic reality of their household. They execute formal capital contributions. Michael assigns a specific percentage of his logistics company revenue into the LLC, and he is issued class A voting shares in return. Sarah assigns the deeds to her real estate portfolio into the LLC, and she receives Class B shares. Every single asset they acquire together, from the primary residence in Chicago to their investment portfolios, is purchased not in their individual names, but under the corporate umbrella of the LLC. Let us analyze the step-by-step mechanics of how this corporate structure fundamentally alters the daily financial operations of a household. In a traditional marriage, commingling funds in a joint checking account creates a massive forensic accounting nightmare during a divorce. In a marital LLC, there are no joint accounts. There is only the corporate treasury. The operating agreement outlines specific capital calls, legally obligating both Michael and Sarah to contribute a defined amount of operating capital each month to cover the corporate overhead, which includes the mortgage, utilities, and grocery expenditures. Furthermore, they are bound by strict corporate fiduciary duties. If Michael unilaterally takes money from the corporate treasury to fund a reckless, highly speculative investment that results in a massive loss, Sarah does not have to wait for a divorce to seek financial retribution. she can immediately initiate a commercial lawsuit against him for a direct breach of his fiduciary duty of care to the LLC. The ultimate failsafe, the true equivalent of our historical divorce insurance concept, activates the moment the romantic relationship ends. In a traditional marriage, you file for divorce and brace for years of unpredictable litigation over who gets the house. In the marital LLC framework, a romantic breakup is completely legally irrelevant. Instead, the separation triggers a predetermined corporate dissolution protocol coded directly into the operating agreement, most commonly a highly aggressive commercial mechanism known as a buy-sell agreement. Historical trends in corporate joint ventures show that buy-sell agreements are designed to swiftly and mercilessly separate intertwined partners without destroying the underlying assets. The operating agreement might dictate a mandatory shotgun clause. If Michael wants out of the enterprise, he is legally forced to offer a specific, binding cash price to buy Sarah's shares. However, the mechanical brilliance of the shotgun clause is that Sarah now possesses the absolute right to either accept that cash and walk away, or turn around and buy Michael's shares for that exact same price. This forces Michael to calculate a mathematically perfect, irrefutably fair valuation, because if he lowballs the offer, Sarah will simply buy him out at a massive discount. If a dispute arises during this corporate unwinding, the strategic advantage of this framework becomes undeniable. They do not litigate the dispute in an Illinois family court, where a judge might be swayed by emotional testimony regarding infidelity, emotional neglect, or subjective arguments about who contributed more to the relationship. The operating agreement strictly mandates binding private arbitration or dictates that all disputes must be settled in the Delaware Court of Chancery. Commercial judges and corporate arbitrators do not care about broken hearts, moral failings, or emotional trauma. They only look at the four corners of the contract. They look at the capitalization table, the documented fiduciary breaches, and the exact language of the buy-sell provision. The division of the household wealth is executed with the speed and emotional detachment of a corporate merger or acquisition. By analyzing these potential outcomes, we can see how the modern elite are bypassing the entire concept of traditional marital insurance. They are not waiting for an actuary to calculate their risk pool, and they are not relying on a state legislature to pass favorable asset protection laws. They are taking matters into their own hands by transforming their domestic lives into highly regulated, self-contained corporate ecosystems. This approach completely eradicates the moral hazard arguments that destroyed early commercial divorce insurance products. Nobody accuses a corporate joint venture of encouraging moral decay when two companies decide to part ways. This hyper-rational corporate structure perfectly protects the real estate, shields the private equity, and mathematically divides the digital tokens. It solves the asset division problem with brutal, undeniable efficiency. But humans are not purely economic engines, and the sterile architecture of corporate law eventually collides with an unstoppable biological reality. What happens when this calculated corporate entity introduces unpredictable human variables? You cannot issue membership units to a newborn baby, and you absolutely cannot dictate child custody, visitation schedules, or parental rights through a commercial buy-sell agreement. A Delaware commercial judge has zero legal authority over the welfare of a human child. When the biological legacy of a bloodline collides with the cold machinery of the household LLC, the entire strategy faces a catastrophic, existential vulnerability. How do the true dynastic families engineer a system that not only shields their wealth from their spouses, but dictates the lives, marriages, and financial behaviors of their unborn descendants centuries into the future? You are about to uncover the deeply hidden, highly controlled world of dynastic family offices and the psychological engineering of generational wealth. The catastrophic vulnerability of the marital limited liability company we just analyzed becomes painfully obvious the moment biological reproduction occurs. A corporate operating agreement, meticulously drafted by Delaware commercial attorneys, possesses absolute authority over real estate, tokenized digital assets, and corporate revenue streams. However, it possesses zero legal authority over the physical custody, educational upbringing, or psychological welfare of a human child. In the year 2026, the American family court system retains extreme, unyielding, and exclusive jurisdiction over matters of child custody and child support, operating under a highly subjective legal philosophy known as the best interest of the child doctrine. You cannot force a commercial judge to enforce a buy-sell agreement on a toddler. The moment Michael and Sarah introduce children into their heavily fortified corporate household, they instantly reopen the heavily guarded gates, inviting the unpredictable, highly emotional, and dangerously subjective jurisdiction of the family court back into their financial lives. To solve this profound biological vulnerability, the absolute pinnacle of the global financial elite completely abandon the concept of individual wealth management and transition into the realm of institutional dynasty building. They establish a family office. Imagine a private, highly secretive investment bank, law firm and intelligence agency combined into a single corporate entity, existing solely to serve the biological descendants of one specific bloodline. This institution completely separates the control of the wealth from the individuals who actually consume the wealth. When Michael scales his enterprise into the multi-billion-dollar stratosphere, he ceases to act as an individual patriarch and becomes the institutional founder. The family office takes over, deploying a terrifyingly effective, multi-generational legal structure known as the dynasty trust. Let us meticulously deconstruct the step-by-step mechanics of how a dynasty trust functions as the ultimate, preemptive divorce insurance policy, not just for the founder, but for descendants who have not even been born yet. Unlike the domestic asset protection trusts we explored earlier, which are primarily designed to shield the creator from their own immediate liabilities, the dynasty trust is engineered to utilize specific legal loopholes, such as the abolition of the rule against perpetuities in states like South Dakota or Alaska, allowing the trust to exist theoretically forever. The family office aggressively leverages historical trends in tax law, specifically utilizing the generation-skipping transfer tax exemption to legally pack billions of dollars into this perpetual vault. But the true genius of this structure lies in its psychological engineering and behavioral control. The family office does not simply hand out inheritance checks to Michael and Sarah's future children. Instead, the dynasty trust operates through highly restrictive, conditional distribution clauses. The wealth is weaponized to dictate the romantic and legal behavior of the bloodline. Imagine their son, David, growing up in the year 2046. David possesses no actual wealth in his own name. He is merely a discretionary beneficiary of the massive institutional trust. When David decides he wants to marry, he faces a profoundly different reality than the average citizen. He does not sit down with his fiancée for an awkward, emotional conversation about drafting a prenuptial agreement. He simply introduces his fiancée to the board of directors of the family office. The family office acts as the ultimate, unyielding bad cop. The institutional lawyers inform the prospective spouse that David owns absolutely nothing, and therefore, there is no marital property to divide under standard family law. However, the trust document, drafted decades earlier by Michael, contains an ironclad poison pill provision. It dictates that if any descendant enters into a legal marriage without executing a highly specific, pre-approved, drastically restrictive prenuptial agreement drafted by the family office, that descendant is instantly and irrevocably entirely disinherited. Their access to the trust distributions, the private aviation, the real estate portfolio, and the generational capital is immediately severed. This psychological engineering completely neutralizes the emotional friction of marital risk mitigation. The heir can genuinely look at their partner and say that their hands are legally tied by an uncompromising corporate board and the legally binding wishes of a deceased ancestor. The prospective spouse is forced to sign a contract that waives all rights to alimony, all rights to the trust assets, and explicitly dictates the financial terms of a potential future divorce, all before the wedding invitations are even printed. The family office essentially underwrites the marriage, treating the incoming spouse not as a romantic partner, but as a high-risk external contractor who must sign a strictly defined non-disclosure and non-compete agreement before entering the dynastic ecosystem. But what happens when this intense, preemptive legal firewall fails to prevent a catastrophic personal breakdown, and a custody battle over the dynastic grandchildren ensues? The family office does not panic, nor do they rely on the subjective fairness of a local family court judge. Instead, they deploy the strategy of infinite legal attrition. They understand that the family court system is fundamentally designed to process middle-class disputes, and it completely breaks down when subjected to the overwhelming, limitless financial resources of an institutional powerhouse. The family office will deploy teams of specialized appellate litigators to challenge every single minor procedural ruling. They will hire armies of private investigators to meticulously document every movement, association, and behavioral flaw of the opposing spouse. They will retain the most expensive, highly credentialed psychological evaluators and pediatric specialists in the country to flood the court docket with overwhelmingly complex, heavily biased expert testimony. The potential outcomes are devastatingly predictable. The family office does not necessarily need to win the case on its fundamental legal merits. They simply need to mathematically exhaust the opposing spouse. They weaponize the cost of litigation, forcing the ex-spouse to spend hundreds of thousands, if not millions, of dollars just to respond to the endless barrage of legal motions and discovery requests. They turn the family court process into a war of financial endurance that the isolated, external spouse cannot possibly survive. Eventually, facing total personal bankruptcy and severe psychological burnout, the opposing party capitulates, accepting a tightly controlled, highly restricted settlement and custody arrangement entirely dictated by the family office. The institution protects the bloodline and the capital by executing a flawless demonstration of overwhelming, uncompromising financial force. We have now traveled from the humble origins of failed commercial casualty policies in America to the ancient, embedded deferred obligations of Islamic contracts. We have dissected the default mathematical firewalls of European property regimes, navigated the impenetrable shadows of international offshore trusts, and decoded the experimental, hyper-efficient architecture of programmable blockchain marriages. We have seen how the modern elite build corporate fortresses and dynastic family offices to completely insulate their legacy from the emotional devastation of human relationships. We have constructed the absolute ultimate framework of modern wealth preservation. But every single one of these complex strategies, from the South Dakota Trust to the decentralized smart contract, relies on one fundamental unspoken assumption. They all absolutely require a functioning, stable society to enforce them. They require a government to recognize property rights, a court system to issue judgments, or an electrical grid to power the cryptographic ledgers. What happens to your meticulously protected wealth, your offshore structures, and your marital contracts when that foundational assumption violently shatters? What happens when you face an event that does not just dissolve a marriage, but dissolves the state itself? To understand the absolute apex of risk mitigation, we must confront the illusion of permanence. Every single legal structure we have analyzed thus far, from the American prenuptial agreement to the South Dakota Dynasty Trust, from the Islamic Mar to the decentralized smart contract, relies entirely on a foundational assumption of systemic stability. They all require an operational society. They require a government to respect property rights, a judicial system to enforce commercial contracts, or a globally connected electrical grid to process cryptographic ledgers. But historical trends consistently demonstrate that nation-states are fragile, fiat currencies are subject to hyperinflation, and legal frameworks can be suspended overnight by emergency decree. Imagine it is late in the year 2026. A massive, unprecedented macroeconomic shock triggers a sovereign debt crisis in the United States. The federal government enacts strict capital controls, completely freezing all outbound international wire transfers. The domestic court systems are paralyzed by backlogs, and the underlying fiat currency begins a rapid, violent devaluation. In this scenario of systemic fracture, your meticulously drafted marital limited liability company and your offshore Cook Islands trust suddenly become totally inaccessible, rendered practically worthless by geopolitical force majeure. When you face an event that dissolves the operational capacity of the state, the entire concept of family law equitable distribution evaporates. You are no longer fighting your spouse for a percentage of a digital bank ledger. You are both fighting for fundamental financial survival. To understand how the absolute ultra-wealthy engineer an insurance policy against both marital dissolution and systemic collapse simultaneously, we must examine the historical case studies of capital flight during the collapse of the Russian Empire or the hyperinflationary spiral of the Weimar Republic. In those historical moments, paper contracts, domestic trusts, and state-backed insurance policies burned to the ground. The only wealth that survived the transition was tangible, highly portable, universally recognized, and held entirely outside the heavily monitored banking system. In our modern context, this translates to the strategic acquisition of high-density physical bearer assets stored in sovereign, non-bank free ports. Consider our hypothetical executive, Michael, anticipating not just the potential outcome of a hostile divorce, but the potential outcome of a paralyzed domestic banking system. He does not rely solely on digital ledgers or domestic real estate. Years prior, he legally converted a significant portion of his corporate wealth into investment-grade, physical assets. We are not talking about standard gold bars, which are heavy and difficult to transport across borders. We are talking about extremely rare, internally flawless colored diamonds, museum-grade fine art, and specialized physical commodities. These assets possess immense, concentrated value, A single flawless blue diamond can hold $20 million of wealth in an object the size of a thumbnail. Michael physically transports this ultra-high-density wealth to a private, heavily fortified free port located in a neutral jurisdiction like Geneva, Switzerland, or Singapore. These free ports operate outside the standard customs jurisdictions of their host countries. More importantly, they operate completely outside the traditional global banking system. When a Chicago family court judge, in the midst of a national financial crisis, demands a full accounting of Michael and Sarah's marital estate, the discovery process hits a physical and jurisdictional wall. The free port is not a bank. It is not required to automatically report holdings to international tax authorities through standard financial data sharing agreements. The vault is rented under a corporate shell, and the asset inside is entirely unregistered. If Michael refuses to disclose the existence of the vault, the family court has virtually no mechanical way to find it, freeze it, or divide it. The physical asset becomes the ultimate, unbreakable financial parachute, immune to inflation, immune to capital controls, and entirely immune to judicial division. But protecting the physical capital is only half of the equation in a systemic crisis. The ultimate divorce insurance policy in a collapsing system is the ability to unilaterally change the legal battleground itself. This brings us to the highest echelon of jurisdictional arbitrage, the strategic acquisition of a second citizenship. The global elite do not simply hold multiple passports for vacation purposes. They hold them as the ultimate firewalls against domestic legal liability. Through highly regulated citizenship by investment programs, an individual can legally purchase sovereign citizenship in nations like Malta, St. Lucia, or Vanuatu by making a significant economic contribution to that country. Imagine the strategic leverage this provides during a hostile marital dissolution, compounded by a domestic crisis. Sarah initiates a devastating scorched earth litigation campaign against Michael in the Illinois family court system. She attempts to deploy Mar-Eva injunctions and civil contempt charges to break his domestic trusts. But Michael is no longer merely a United States citizen subject exclusively to the whims of an American judge. He activates his second passport, boards a private flight, and physically relocates to his new country of citizenship, a nation that historically refuses to extradite its own citizens for civil financial disputes or recognize the authority of foreign family courts. By physically removing his person from the jurisdiction of the United States, Michael completely neutralizes the threat of civil contempt. The Chicago judge can issue endless orders demanding his incarceration for failing to repatriate funds, but those orders hold absolutely zero physical power over a sovereign citizen residing in a foreign nation that does not recognize the judgment. Michael essentially hits the reset button on the entire legal process. If Sarah wishes to continue pursuing the marital wealth, she must now navigate the incredibly complex, highly unfavorable family law statutes of a foreign nation, fighting a local citizen on their home turf. The sheer cost, time, and logistical impossibility of waging an international legal war during a global economic crisis force an immediate, drastically reduced settlement. The second passport serves as the ultimate insurance policy, buying freedom from a hostile jurisdiction when the domestic system becomes a weapon of mutual destruction. Over the course of this extensive historical comparison, we have entirely deconstructed the American illusion of marital finance. We have seen how the United States relies on a reactionary, emotionally driven, and financially devastating legal cleanup process, historically rejecting the very concept of private divorce insurance due to an obsession with moral hazard. We have contrasted this with the proactive, mathematically rigid systems of the rest of the world. We traveled from the ancient, built-in deferred obligations of Islamic contracts to the modern, default asset separation regimes of France and Germany. We navigated the impenetrable shadows of the Cook Islands offshore trusts and explored the terrifying, hyper-efficient future of programmable blockchain marriages. We even witnessed the emotional detachment of the marital limited liability company and the relentless generational control of the dynastic family office. You now possess a framework of knowledge that the vast majority of the population will never even conceptualize. You understand that true asset protection is not about hiding money from your spouse. It is about utilizing historical trends, legal friction, and jurisdictional arbitrage to mathematically eliminate the possibility of total financial ruin. You understand that a contract is only as strong as the entity enforcing it, and when that entity is a highly unpredictable family court judge, you are effectively operating without a safety net. The mechanisms of risk mitigation exist, they are highly effective, and they are actively being deployed by those who understand the true economic machinery of human relationships. But as we close this comprehensive deep dive, a massive looming question remains completely unanswered. We have spent this entire journey analyzing how individuals protect their wealth from their spouses, from their family members, and from the courts. We have assumed that the primary threat to your financial legacy is the dissolution of a romantic partnership. But what happens when the entity aggressively attempting to seize your generational wealth, liquidate your assets, and dismantle your corporate fortresses is not an angry ex-spouse, but the very government that printed your money in the first place? What happens when the historical trends of sovereign debt reach their mathematical breaking point, and the state turns its sights on the private wealth of its own citizens? In our next masterclass, we will completely invert the paradigm. You are about to enter the terrifying hidden history of sovereign wealth confiscation, and you will discover exactly how the true global elite build invisible financial empires designed to survive the death of the American dollar.